Hello and welcome to the Fancy Yancy Financial Capital Church Fund. We are broadcasting today from Raleigh, North Carolina, and we have a deluge of exciting market action for you today. The emerging markets implosion continues, and it is entertaining. We're going to go over a little bit of the events here today and have the Reverend preach about what he thinks is going on. Now you can also follow us on Steemit at the Reverend FYF and get updates every several times every hour on what's going on in the markets. All right, bear with me a second. Just gonna give you guys a recap of what happened today. Big story of the day is on the global mega debt panic crisis implosion. Equity markets are still not reflecting the global mega debt panic crisis implosion. And if you listened to our broadcast yesterday, not unexpected, especially with the quantitative easing by the Fed and other money printing by the other central banks, namely the Swiss National Bank, which is buying up a lot of American equities, no matter what the price. The Norwegian Sovereign Wealth Fund, also buying up a lot of equities, no matter what the price. The Bank of Japan, also buying up all sorts of instruments, not only in their country, but ours. Though it looks like in several of the charts, there are reductions in its treasury holdings. Again, they're not stupid. They know what that stuff is worth. But currently, there was an increase in the US 10 and I think 30-year bonds. Again, a flight to safety from the global mega debt panic crisis implosion and the EM currency markets that are causing it. Well, part of it. The debt problem was there a long time to begin with, or a long time before. And the markets, the treasury markets and the G10 seem to be affected with it as well in the flight to safety. Now the Reverend would actually put his money in the euros and such, but Swiss debt, or possibly even the Japanese, because they look like they have no signs of tapering their buying. And you've heard the Reverend's opinion on the U.S. Treasuries, but for now, they're probably the most liquid, and the ones you can get out of as soon as the EMs stop imploding. Though you might have a little shortage in liquidity there. Speaking of which, Zero Hedge today posted a nice article from, let's see here. Bear with me a second. Here it is. Oh, looks like I didn't link it. Oh, terrible to make these mistakes. See if I can bring it up here. Bear with me a second. Oh, and apparently the Brazilian real is imploding, Venezuela style. As again, the Reverend strongly believes that all Latin American currencies are now toilet paper. Bear with me a second here, still looking for the article. Actually, I'm gonna cut the recording off for a second, and we will be back shortly. Sorry about that, had to pause the recording there while I found the article. It's actually here at Zero Hedge, called The New Widowmaker Trade. Actually a pretty good title. This is authored by Peter Tannenbaum via acting-man.com. And he's calling this new trade the Widowmaker trade, or the current shorts in the 10-year, the Widowmaker trade. And a lot of people piled into shorting 10-year, which if you've been paying attention to the Reverend and his sermons, was seen to be toilet paper, earlier in the year. But now, in the current emerging markets implosion crisis, debt panic, and such, there is now a flight to safety to that and the other G10 debt. And if it were my money, I'd probably be going to Switzerland or the Europe or Japanese, as I stated earlier. So it's looking like there's going to be a big short squeeze there, is what he's talking about. And that's what he's calling the Widowmaker, because I guess these people, a lot of people would not have seen the flight to safety there in the current EM implosion, because if you saw the S&P today, everything is still awesome in American equities, where there's no such thing as price discovery. So it's actually not awesome, but it just appears that way if you're not paying attention to the rest of the world. And yeah, so that's what he calls that. But the most interesting part of the article, or the most notable part, I should say, is that he mentions the euro-dollar futures, which are now showing liquidity is drying up. Now, what euro-dollars are, it's called euro-dollars because originally, Europe had a bunch of dollars that they needed for trade, etc. But that's now used to, say any other country's holdings of US dollars and such. And now, these people getting out of their debt, out of their mess, out of that emerging markets mess, flooding to the dollar, fleeing to the dollar. And especially with the dollar appreciating too. Now, that's causing, it's also showing their, liquidity drying up. And if anybody's paid attention in the last couple market crashes, one nice little coincidence as to when liquidity dries up is the market implodes too. Now combine that with all the other events going on. It's I hate that term no-brainer, but you have an idea of what's coming. But otherwise, it's a pretty good article, and you can see it on the fancy Yancy Financial Church Capital Fund on steemit.com. Let me just edit that article there, make sure we have the correct link here. Don't want to leave you hanging. And just got that updated. So, other notable facts of the day. Bear with me, just drawing it up on the old computer here. Oh, very interesting. Again, in the global mega debt panic crisis implosion, commercial lending is slowing as well. And there was an article in Zero Hedge. You know what? In my opinion, Zero Hedge is better than Bloomberg. And you don't have to hear their cheerleaders, talking about insanity like nobody wants the yuan. Yeah, you're fucking crazy if you think that. Let's see here. So, commercial bank C&I lending tumbled from July 11th through August 8th by 15 billion. And it's notable because it is the biggest 4-week decline since March 2017, and before that, in the aftermath of the 2008 financial crisis. Yeah, what you're seeing here, there's a lot less M&A activity too going on right now. And, you know, a lot of this M&A activity, or a lot of the private equity activity too, was driven because of the cheap money available. There was just free money to throw around. But now that it actually costs something, you're seeing that slow down. And I assume it goes the same for anything that might be used for buybacks, or, see what else could you do with that free money there. Anyway, things of that sort. But, yeah, an increase in the cost of lending now makes that not worth it. And that in turn should be reflected into share prices eventually, because they couldn't inflate it with cheap money anymore. So, another very interesting part of the global mega debt crisis, implosion crisis. And let's go back to the Blago here. Oh, another thing going on in the global debt mega crisis. Looks like banks are cutting their exposure to subprime credit cards as the tidal wave of consumer credit defaults are increasing. These people are having trouble paying off their credit cards, which, shouldn't be expected when they have to work multiple jobs that don't pay well instead of one really well-paying job. And sorry, the Reverend does have to eat. He's cooking up dinner here right now. And a lot of consumer credit, and it's not only in the credit cards and those revolvers, you're now seeing it in the home foreclosures, which have increased, as well as the subprime auto, which is just absolutely imploding. So, if anybody questions, the health of the economy, these are very clear indicators. I also have on the blog earlier today showing that, and I've said this in the past as well, just half of people in general cannot afford a first world standard of living. A decent apartment, a cell phone, car, food, etc. They have to share the costs with people. They have to share the apartment. They have to share, probably a cell phone too. They probably have to share cost of the food in form of food stamps or food pantries. So the ability for a lot of people to live under a first world standard is now gone. Half of them, actually. But another interesting article published, a couple months ago, states that even half of millennials, people aged, I think, from about 21 to 37, cannot afford to support themselves. They cannot pay for rent or groceries without the help of their parents because they cannot find a well-paying job. And these are people who have, degrees in fields that, would have been useful maybe 10 years ago, but are not happening now. So, if anybody wants to tell you that the economy is great because of the stock market indices, which again are also skewed by a lot, some of these indices are weighted differently than others. So, especially if it's skewed by, market cap or such, and you're taking a look at a very few companies that are actually just inflating the indices. The rest of the market may not be doing as well. So if anybody tells you that a stock index is a good reflection of your economy, there are better things to be looking at to tell you how you're doing. You know, if your bank account wasn't enough. Oh, and again, the Fed announced earlier today that they're going to continue on with their rate hike path. No surprises there. They're going to continue tapering. You know, and again, this is not something optional for them. So this shouldn't have been a shock to anybody. But the other part of it is that it shouldn't be a shock that what happens in emerging markets is going to continue to happen. And it's not the Fed's fault. It's because these places have had structural issues for decades, and they've been bailed out multiple times, by the IMF or some other entity, and they've never fixed the problem. So this is not the Fed's fault, even though it might be affecting their problems slightly. But the root of the problem is them. Oh, and here is a funny little satire article. That was saying getting a job has never been easier. Well, yeah, getting a job you want is the problem. And there was a post that I put up with the population to the unemployment ratio there. That, they keep giving people the U3 number, which is heavily skewed and just downright incorrect. They tell people that, oh, look, unemployment's low, it's at 3.9%. Yeah, that's because, 50 million people, probably out of that 100 million that are unemployed, that aren't working, have just stopped looking for work. They just gave up. They went on SSI and said they had some sort of disability. It's really shocking that, a lot of these SSI claims, and I'm sure this is something that can actually be looked up on some government website, but a lot of those SSI claims are coming from the most impoverished parts of the country, or impoverished areas. Are they in poor health because they live in an impoverished area, or, which might be the case, or are they just taking SSI because it's an economically depressed area? So that number's heavily skewed, and even if you take a look at the U6 number, which is a better reflection, still skewed. But they have another indicator, or another statistic, basically the people of working age 16 and over who are working versus, the unemployment. And versus how many of them have jobs. And if you take a look at that graph, you can see that these people, that this statistic never recovered from 2008. It never got to pre-2008 levels. Now, and if you want to get political, we keep importing some of these people that wanted to remind me of that they're here to take some of those jobs that don't exist. Now, those jobs too now, just like it's been, we've been stating earlier, or that I have been stating, we as in the Fancy Yancy Financial Church, Capital Fund, financial, whatever we call it, whatever I call it. Now, those jobs are now multiple few hours part-time jobs that don't pay as well as the jobs that were, here before. That required, actual skills, technology, I guess some in technology, some in other backgrounds. And this article, making fun of this stuff really does, hit the nail on the head. There's a line in there saying that millions of jobs opened up to candidates with no experience necessary in the last year. I.e., you don't have to have any real skills, and in turn, do not get any real pay. It's not a high-paying job. That's going to be a job that, you're getting at minimum wage and such. But it is pretty funny. I do recommend reading it. There was a decline in undergraduate enrollment. Yeah, because going to college won't guarantee you a good job anymore. And this is pretty funny. In search of students, and I don't think this is a joke either. In search of students, universities are adding thousands of new majors, including cybersecurity, casino management, hip-hop studies, competitive video gaming, peace education, political campaign management, you name it. Yeah, that's a very good indicator of how well things are going. And that's going to be in huge demand, some of these things. Competitive video gaming, it's not like you can't do exactly what I'm doing and just put a YouTube video with you talking over, a picture or video. You need to go to college for that and be indebted probably a couple $100,000 and default on your student loans, just like half of people who have them right now. Another good indicator of the current global credit mega crisis, implosion, panic. But I'm going to take a little break right now and pause the recording. We'll be back shortly. Or the Reverend will be back shortly. And we are back on. Now I'm going over Zero Hedge here and taking a look at their little market cap or recap for the day today. U.S. stocks reached the longest bull market ever amid ruble, real, and rate curve rout. Again, that's exactly what I was talking about, where especially U.S. equity markets, no price discovery exists anymore. Non-existent. But for some reason, that doesn't reflect the actual implosion. That's not an exaggeration. Implosion you're seeing in the Brazilian real, I guess the Russian ruble now, and again, if I were Russia, fuck it. Yeah, I'd 1998 it all over again. Go to the petro ruble, whatever they want to call it, oil ruble, gold ruble, get in the Chinese trading block, and say fuck these people. And default on that debt. Oh, yeah, such better financial position. They're in the BRICS trading block. That's to me is I don't even see any other option. But the real too, going under, Venezuela style. So yeah. Oh, and it's taking a look to. They put up a nice little chart here. They plotted the S&P against the bull market from the 90s versus the one this year. So it did last a little bit longer. And again, QE fueled nonetheless, but it actually wasn't as strong. That's interesting. And of course, the usual gladiator scene. Are you not entertained? I am entertained. The Reverend is entertained. And they plot a nice little chart that I was talking about earlier with the U.S. employment population ratio against the S&P. And you can see that the S&P, it recovered from 2008, if you want to call it that. It's been inflated from 2008. Thanks for being positive. And the U.S. employment population ratio did not. It's not even close. It's not even half of what it was. Or a third. Hang on, let me see this. No, it's not even half. It's probably closer to a third or so. And again, the U.S. employment population ratio is the people working age or older who are employed. And it still isn't nearly as much as it was prior to the 2008 implosion. But the only thing QE managed to do was, inflate the equities market. And that's not even the debt markets, that's just the American equities market. And it had some help too from other foreign central banks. And again, Zero Hedge plots a nice article here, or a nice chart here, where they have the S&P against the G4 central banks balance sheets. And wow, correlation is damn near to 1, you know. And yeah, whatever. Correlation does not imply causation, but in this case, I mean, just think about it. What did they do with that cash? They put it in the equities markets. Literally. Like the S&B and the Norwegian. And I'm sure the open market operations, or whatever you want to call it, PPT, President's Working Group. Let's call it market manipulators at this point. Price discovery destroyers. Instead of calling them PPT, I think I'm going to start calling them PDD. Price discovery destroyers. But this is also pretty funny too. Now it plots again the G4 central bank balance sheet against the S&P, and now it's showing the tapering of the central bank balance sheet, the central bank's balance sheets now, and you can see it decoupling. But when does that actually get priced in? Probably in, you know, the debt crisis. And China had to go rescue their stocks recently, but it's pretty much stabilized now. Stuff in Europe's pretty much, you know, unchanged. And somehow PDD came to the rescue today, as U.S. equities were manically bid back up to erase all anxiety over the Cohen-Trump deal. Yeah, I'm sure. In any case, you know, price discovery destroyers got in there. And let's see here. Transportation, I guess, was doing pretty poorly because oil's going up because of the weaker dollar. Dow ended lower. Nasdaq's were a little bit up. Again, their weighted averages. You know, I think I explained that in a prior post. Again, likely bid up by the FANGs and such, which again are being bought literally by other central banks. You know, like they're buying shares of them. They're one of the biggest shareholders in them. But the S&P was pretty much unchanged. And the Fed's minutes today pretty much didn't do much. And bonds are still decoupled. This is my favorite chart, the S&P against the 30-year yield. Bonds remain remarkably decoupled from stocks in recent days. I wonder why. I guess the bond market isn't buying it. They're generally smarter investors too, you know, they're not buying the bullshit. Oh, and you also have the fleeing people from the emerging markets looking for a safe haven. And let's see here. And of course the 30-year dipping down. 30-year yield, I mean, dipping down. And the yield curve continues to implode. Wow. And again, that's I like how they plotted the Bank of Japan, or they marked where, you know, when those rumors are going on in the chart there, because the Bank of Japan does have a lot of influence over that yield curve. And let's see here. Dollar dipped. Dollar index, I mean, is down. Weakest in 2 weeks. And so is the yuan. Again, they have their own little peg. Peso rallied somehow, you know, on NAFTA rumors. But again, absolutely ridiculous. They plunged earlier in the day, and I guess they went back up a little bit. All these factories, like I posted one article, or I guess email drafted one article, of a factory in Chicago moving down to Mexico to avoid tariffs from Chinese steel. And the only way that they can prevent that from happening, so that factories don't leave to go down to Mexico, and again, make tariffs essentially worthless, is to place more tariffs on Mexican cheap labor, on every single one of their goods. Everything from agriculture to manufactured products. That's the only way that they're going to have that actually work. Because Ross Perot was right. NAFTA would be a disaster, and it has been. Yeah. Not only did these people send all of the jobs there, I'm talking about the Clinton administration and I guess on, but they had the people there come here to take what was left of the jobs here and drive down the wages. Yeah. Ross Perot was very much correct. And the last thing that I think the Trump administration would ever do is to agree to anything close to NAFTA. Now you have a separate, the issue, there's no real issue with the Canadians because they don't work for that kind of money. I think their labor is actually more expensive up there. It might actually be beneficial to have more open trade with them. Manufacturing things here and then just shipping it there. But this is a very different story from Mexico. But in any case, even with the weaker U.S. dollar, the real was still imploding. There is, again, doesn't have anything to do with the U.S. dollar, because even if it did appreciate relative to all the other stuff, that they have to buy and trade with, it means nothing. And all their structural problems, all the problems as to why they're imploding to begin with, are not anything to do with the United States. And of course the ruble crashed too, as we were saying earlier, because why wouldn't he let it? Fuck it. Go to the petro ruble. Or I guess liquid natural gas ruble. And the same thing's happening here to the rest of those EM dumps too. And crypto is going down again. I don't know. I don't really say much on crypto because it's some new area, just in my opinion. Some new area. It's not as liquid as cash. It's not as good as cash. It's a store of value for people who need a store of value, like people in EM who are seeing ridiculous depreciation of their currencies. But other than that, it's, for example, it's kind of just like a hassle. I run the Steemit thing. I got 9 cents worth of Steemit. Is it worth it for me to go through all the trouble to, exchange that? Nah, not really. Oh, and gold or metals, where gold was flat, copper and silver are lower. But again, those metals markets are just absolutely manipulated. Part of the reason why is that you cannot have gold soar and have it imply that the dollar is worth so little. Because if they didn't sell those naked shorts on the COMEX, if you see gold at 10,000, that would imply that the dollar is worth that little. And they're not going to let that happen. So again, that's another market. Because physical gold might actually trade differently. Now, because of the shortage of gold, and there is a shortage going on, to get actual physical delivery, you're probably going to have to pay more than spot. So that becomes its own market outside of the futures markets that, these prices report. And again, they're another market where price discovery does not exist anymore because it's manipulated. And West Texas Intermediate, the light sweet crude, is going back up. I think the church here is still looking at 100. Now it is the end of the summer though, or the summer's winding down, I mean. But with all those events going on, Venezuela losing PDVA, I think it is. China, of course, just increasing demand. And of course, the dollar weakening. Of course, I think the nominal price is going to be going up a little bit. And they have a nice little chart here. Oh, it's the City Economic Surprise Index. I actually don't know anything about this index. I should look it up. But yeah, it's funny. It's saying that the U.S. economy and the Chinese economy are, really not doing that well. And China's fine with their trading block, but this debt-fueled stuff, and especially with them trying to reduce any problematic debt, which is actually incredibly smart because the rest of the world hasn't caught on to that idea yet. That's why you have your global debt mega panic there, implosion, and some guy they put on we tweeted today, goes by Econ Guy Rosie on Twitter, David Rosenberg. Yeah, it's exactly the same thing I'd say, I guess. With the subpar home sale report, the running tally so far for this month shows 12 data points, missing consensus views to the downside, 5 beating and 3 in line. So if that characterizes a strong economy, I'd be interested to see what a weak one looks like. I think I'm going to finish this video with this. But yeah, again, you have weaker home sales, you got more foreclosures, you got banks knowing that consumer debt's imploding, slashing credit card exposure, subprime imploding. Then you have all these emerging markets just going down the drain. The economic outlook doesn't look that great. It really does not. Yeah. And of course, that nice little index showing that people of working age aren't actually working, and aren't working as much as they were in 2008 or prior to. Yeah. All the little fairy tales seem to look just like that. Fairy tales. But that is it for August 22nd here in Raleigh, North Carolina. It is Wednesday, and Thursday's broadcast should be up soon. Should be up tomorrow. I am the Reverend. Thank you. Blessings. And there is victory in Jesus.